Question number 3. It's related to the cash flow statement. TGPLC is an expanding company with a financial year end of 31st December. A junior member of the account staff took the statements of financial position of the company at 31st December 2022 and 2021 and prepared the following draft statement of cash flows. Profit for the year 76,000. Increase in property, plant and equipment 472,000. Increase in inventory 14,000. Increase in trade receivables. Increase in trade payables. Increase in tax payable. Decrease in interest payable. Increase in long term bank loan. Increase in ordinary share capital. Increase in revaluation reserve. Decrease in share premium. Cash flow from activities. Dividend paid. Net cash flow. Bank balance at 1st Jan 2022. Bank balance at 31st December 2022. Further information is available as follows. The statement of profit or loss showed a tax charge of 32,000 and finance expense of 15,000. Number 2, share capital consists of ordinary share of $1 each. Two share issues were made during the year. The first was a bonus issue of 300,000 shares, which was funded entirely from the share premium account. The second was a right issue of 100,000 shares at a premium. New machinery 348,000 was bought. Motor vehicles with a carrying value of 56,000 were sold for 71,000. Requirement number 1. Read source C in the insert. Prepare the corrected statement of cash flows for the year ended 31st December 2022 in accordance with IAS 7. Cash flow from operations 156,000. This we calculated at the end of the question. First we will fill all the information, then through the missing figure we can calculate this 156,000. Less interest paid. Its working is in the question. Interest paid is 15,000 plus 3,000, 18,000. Tax paid is 32,000 minus 6,000, which is 26,000. Ordinary share capital is 400,000 minus 300,000 is equal to 100,000. Share premium 300,000 minus 250,000 is equal to 50,000. So total proceeds from issue of shares is 150,000. These are the workings, and now we can fill these. Interest paid is 18,000 as calculated in the working. Tax paid is 26,000 as calculated in the working. Then cash flow from operating activities we can calculate by the missing figure. Investing activities, proceeds from sale of non-current assets, and 71,000. Payment to acquire non-current assets. Payment to acquire non-current assets was 348,000. Cash flow from operating activities will be 112,000. Okay, cash flow from investing activities will be 227,000. From financing activities, issue of shares 150,000. Bank loan is 30,000, and dividend paid is 54,000. Total financing inflow is 126,000. So net cash flow is 11,000 given in the question. Cash and cash equivalent beginning is given in the question, and cash and cash equivalent ending also given in the question, 28,000. Now first of all we will go missing figure like 28,000 and 17,000 minus 17,000 we will get 11,000. Then 126,000 minus 227,000, so we will get 112,000. Then we add 26,000 and 18,000, so we will get 156,000 cash flow from operations. The directors expect that as a result of the expansion of the business, investors will see changes in some of the company's investment ratios in the coming year. Discuss without making calculations why the following changes might take place. Decrease in earning per share. Earning per share decreases when company issue new shares, right shares or bonus shares. It might be decrease due to decrease in profit for the year, higher loan interest may be the reason. Increase in price earning ratio. A high price earning ratio could mean that a company stock is overvalued of that investors are expecting high growth rate in the future due to decrease in earning per share. It may increases. Decrease in dividend yield. The biggest factor impacting dividend yield is company's stock price or share price. When share price rise, dividend yield fall, profit decrease, and share increase, number of shares increase, leads to decrease dividend per share, which decrease dividend yield. Additional information: the directors are considering making another bonus issue of ordinary shares in a year's time. Advise the directors whether or not another bonus issue would be beneficial. Justify your answer. Bonus shares dilute the ownership, earning per share, and dividend yield may decrease. Bonus issue may have negative market perceptions that company better involvement opportunity and trying to boost share price artificially. It may increase administrative cost. Some shareholders may hold share offer taking bonus shares, so it may decrease market price. It may, in my opinion, it's not beneficial.